We'll throw up at JPMorgan, try to go back a few years. You'll see, to your point, we're trading at prior all-time highs. We're also trading at about 170%-ish of book value, north of 2 times tangible book, which for JPMorgan gets a little bit extended in terms of valuation. People will look at it at price to earnings. I don't look at it that way. I look at it just in terms of price to book and tangible book. Given the run-up we've had, I think they really got to knock the cover off the ball to get this move going to the upside, given all sort of the headwinds that all these banks face, not least of which JPMorgan.
True. And banks historically, I mean, the last 5 or 6 quarters going into their numbers have really been on the skids. And so it is a little uncomfortable to see this, even though as a bank investor in a couple of the money center banks, I'm happy that the market is willing to put a bigger multiple either on their tangible book value, which I think is really probably the most appropriate. Guy's right. JPMorgan trades at a premium to the group. And Citibank, which at one point was around 0.55 price to tangible book and just got too cheap. And you talk about that restructuring and some of those costs. The story with Citi is really one where I think we're trying to think of this bank in a new era, in a new light, and a bank that's thinking about efficiencies, a bank that's thinking about productivity. And I think that's a multiple that actually can go higher. I think we expect to hear that their capital markets business probably, at least for this cycle, hit a bottom, either last quarter or the quarter before, that actually there's some resurgence in M&A and origination and some of the dynamics on the banking side. FIC, I have a feeling it's going to probably be strong. But for Citibank, it's been about this sprawling kind of presence globally that at times has been its own biggest nightmare. And I think this is a good era for Citibank. And I think the other side of this also is banks and capital and their ability to give capital back. Seems like we're a long way away from SVB at this point. In other words, in a good way for these banks, and I think investors are ready to get back in.
I mean, a long way. Banks are, in general, up 35% since SVB. So that's a long, long, long way. And for Citi, I mean, it's about rationalization of this sprawling empire you had mentioned, a restructuring story. We had Mike Mayo come out and say that Citi was his top pick. He really liked the story. And then we have BMO today cutting it to a market perform.
Yeah, I think, well, Mike Mayo is usually bullish on banks, right? And he had a good year last year. But if you look at JPMorgan and Wells Fargo, those were the ones that really stood out as performers. I don't think that could happen again. And when you look at earnings trough, earnings bottom for most sectors. Financials, probably not. So I think financials are gauged to be down roughly 3 or 4% on the whole. But the insurance, and this is through FactSet, the insurance arm of that is the one that's boosting it. So without the insurance arm of the financials should be down 8%. So I know that everyone waits for the financials to lead the market in the earnings. I'm bullish, but I don't think we're going to get great, stunning performance.
I don't think they've led for a long. I mean, they haven't been that sort of barometer for earnings since probably before the financial crisis at this point. But in terms of the valuations going into the other thing to layer in is if you believe that a credit cycle is going to happen. And that was sort of the point of this overarching BMO industry analysis in which it did downgrade Citi. It downgraded AXP as well. Second downgrade this week for American Express. But the concern is about credit quality, about the consumer's ability to pay, increasing delinquencies, et cetera.
I think Liz Ann Saunders put out a tweet today. Credit card interest rates are now at the highs we haven't seen probably in the last 15 years, if not all times, 21.5% on average, which is extraordinary if you think about it. And your point is well taken. I do think there's going to be a credit event, and I do think unemployment rates going higher. I might be wrong, though. But if you think those things are minutely possible to happen, I think banks are going to be at least headwinds for the banks are going to be there for the beginning part of 2024. With all that said, I mean, JPMorgan, if you look at flat earnings growth in terms of year over year, flat revenue growth in terms of year over year. And, oh, by the way, Jamie Dimon's been pretty dour over the last 18 months. It's going to be interesting to see what he has to say, if he even speaks on the call.
And there's going to be a succession plan. I think that's going to be the 2024. We're going to be worried more about where Jamie Dimon is going versus or who's taking over. So he's already stated that he's going to stay on until, what's the number? 2026, until the headquarters is done in the city. Yeah. Is that the date?
The headquarters are done. They're still building. I drive by
that's
every day.
I think that will dominate the conversation, but it's going to be hard. The premium that is put on JPMorgan with Jamie Dimon at the helm is probably very large, more than we can really establish. So that goes
away when the succession plan is announced?
That's what I would guess.
I look at how investors are approaching the whole sector. And Guy's right. The consumer is only going to weaken in terms of their credit quality. But it's amazing how the broader market dynamic that's including banks in some level is, I think, because of banks. We're living in a world where the sense is that the worst of the Fed's pressure is also letting up on the banks. And I think that's part of what this needs to be. There's no question that banks were pricing in a whole lot of credit concern that 2 or 3 quarters ago was even less apparent than it is today. In other words, I think there's still some of that to take off of the headwinds that were priced on these banks, by the way. And then you have Morgan Stanley and Goldman Sachs and some of the brokers reporting. I think it's, again, kind of a noisy quarter, but a place where they definitely saw a return to some of those M&A dynamics that I think had really deteriorated. And I think going forward, they're going to be optimistic on what's coming. If you think the rates are going down significantly, then maybe then some of the companies that are coming to market can be more patient in trying to raise debt and do equity deals. But look, if you think that there's a window that's open here, and I think central banks around the world, by the way, over the last week or so are showing they're trying to raise as much debt as possible. I think with lower rates, you're seeing companies run to market. I think that the capital markets dynamic is going to be very strong.
That's what James Gorman of Morgan Stanley said. He said when rates come down, you're going to see the floodgates open in terms of M&A and deals.
Yet he chose this year or last year
to
announce his retirement. Now, he got in at the right time. A lot of people say maybe he's exiting at the right time as well. I'm fascinated to hear, again, what Jamie Dimon says in terms of commentary, given what he's said over the last 18 months or so. And he really hasn't wavered in terms of some of the headwinds that he thinks are out there. If some of those headwinds have abated, I'd like to hear what he has to say.